What if the greatest financial lie was not the one that caused the 2008 crash? What if it was the one everyone believed? Right before the clock struck midnight on the year 2000. It starts with the silence. The sound of telephones that stopped ringing. The sound of $50 billion evaporating. Then 100 billion. Then $1 trillion. One day, they were printing money, minting millionaires in garages, launching startups with no product, no profit, and billion-dollar valuations. They called it the new economy. The next day, those garages were empty. The champagne bottles were gone. The money vanished. And this was not just a bubble. It was a mass delusion, a collective fever dream where the fundamental laws of economics were declared obsolete. They insisted that this time it was different. They were wrong. This is not a history lesson about the year 2000. This is an investigative blueprint, a warning system, because the lie that fueled the dot-com deception, the belief that fundamentals do not matter, is the single most dangerous idea in finance, and it is the exact same lie being sold to you today. It began with a spark. August 9th, 1995. The Netscape IPO. This company was not like the industrial giants of the past. It did not build cars. It did not drill for oil. It did not even have profits. It had a browser, a gateway, and on its first day of trading, its stock more than doubled. Wall Street was confused. The old guard? The men in expensive suits who worshipped price-to-earnings ratios, the old world metric for valuing a company based on its actual profits. They saw a company losing money, but a new generation. They saw the future. Suddenly, the old rules were for dinosaurs. A new economy was born, and in this new economy, profit was a weakness. It meant you were not growing fast enough. The new metrics were intoxicating. Eyeballs, page views, user acquisition, burn rate. This last one was the most perverse. The burn rate was how fast a company spent money it did not have. And in the mania of 1998, a high burn rate was a badge of honor. It meant you had ambition. Venture capital firms became kingmakers. They poured hundreds of millions of dollars into concepts sketched on napkins. The goal was not to build a sustainable business. The goal was to get big fast and go public. An IPO, initial public offering, became the exit strategy. It was a way for the insiders, the founders, and the VCs to dump their shares onto an eager public. And the public was desperate to buy. Day traders, taxi drivers, dentists. Everyone was a stock market genius. You could not lose. A company called the Dotcom went public. Its stock rose over 600%. On its first day, companies that did not even have .com in their name raced to add it. A small, failing logistics company added .com to its name, and its stock shot up 1,000%. It did not change its business, it just changed its name. They spent fortunes on advertising. Pets.com, a company that sold dog food online at a loss, spent millions on a Super Bowl ad. This was not business. This was a religious frenzy. Analysts on television, the new high priests of the cult, fanned the flames. They placed strong buy ratings on companies that were hemorrhaging cash. Companies with no assets, no profits, and no plan. One analyst, Henry Blodgett, became a superstar by placing an impossibly high price target on Amazon. When it hit the target, he was hailed as a prophet. The banks did not care if the companies were real. They only cared about the underwriting fees for the next IPO. It was a perfect, self-sustaining ecosystem of delusion. The VCs funded the startups. The startups spent the money on advertising. The media hyped the stocks. The public bought the stocks, pushing prices higher. The VCs and insiders sold. And the public held the bag. It was the greatest transfer of wealth, disguised as a revolution. The end did not come as a sudden crash. It came as a slow, agonizing realization. It started with a simple question. Wait, when will these companies actually make money? For 5 years, asking that question was heresy. Now, it was the only question that mattered. And the answer was never. The new economy was a lie. Eyeballs could not be converted into dollars. Burn rates were not investments, they were just, burning. The collapse was brutal. $5 trillion in market value evaporated. Webvan raised $700 million to build a grocery delivery business. It built massive, automated warehouses. It went bankrupt in 2001. Pets.com burned through $300 million. Bankrupt. HTTPS. www. Google.com/search. Cosmo.com. Promise delivery of anything. Movies, snacks, magazines. In under an hour, bankrupt. The 25-year-old millionaire CEOs were gone. The television analysts were silent. The small investors, the ones who bought at the top, believing the hype, they were destroyed. Their retirement accounts, gutted. Their college funds, gone. They were left with worthless stock certificates and a profound sense of betrayal. And here, the blueprint locks into place. Why does this history matter? Because the story did not end in 2001. The mentality did not end, it just went dormant. A company with no product, burning through cash, promising to disrupt an entire industry. Investors piling in, not based on profit, but on a charismatic founder and a futuristic story. Financial media breathlessly hyping the next big thing, a belief that this time, because of this new technology, the old rules of value do not apply. Does that sound familiar? It should. The technology changes. The internet, the smartphone, artificial intelligence, cryptocurrency. But the sales pitch, the lie, remains identical. The dot-com deception was not the last time you would be told that eyeballs matter more than earnings. Today, they just call it daily active users. It was not the last time you would be told that profits are an old-fashioned metric. Today, they call it growth at all costs. The dot-com bust was the warning shot. It proved that the system, the VCs, the investment banks, the media, could and would inflate a narrative, sell it to the public, and cash out before the inevitable collapse. They learned their lesson, not that bubbles are dangerous, but that they are incredibly profitable. If you get out in time, the question is, did you learn yours? To understand the dot-com deception, you must stop looking at it as an accident. It was not a spontaneous, collective mania. It was a machine, a carefully constructed system for separating dumb money from its wallet. And this machine has 3 core components. Component 1, the factory, the venture capitalists. These were not visionaries, they were operators. Their business was not to build companies. Their business was to package companies for an IPO. They took a simple idea. Say, selling pet food online, wrapped it in the language of revolution. and gave it a valuation pulled from thin air. They knew most of these companies would fail. It did not matter. They only needed one. One Netscape, one Amazon, to pay for all the losers, and for the rest, they would dump them on the public market. Component 2. The salesmen, the investment banks. These were the gatekeepers. They decided which companies got to go public, and they made billions in fees for doing it. But they had a dirty secret. It was called spinning. They would allocate the hottest IPO shares. The ones guaranteed to pop on day one, to their favorite clients, CEOs, politicians, and other insiders. It was a legal bribe. In return, those CEOs would give that same bank their future business. It was a closed loop of enrichment. But what about the retail investor, the public? They were not given the IPO price. They were only allowed to buy after the stock had already skyrocketed. They were the dumb money. The exit liquidity. Component 3. The megaphone, the financial media. The media's job is supposedly to provide skeptical analysis. Instead, they became cheerleaders. Ratings exploded. Every buy recommendation, every absurd price target, was a hit of dopamine for an addicted audience. The analysts who worked for the big banks were not analysts. They were marketers. Their research reports were glorified advertisements, designed to sell the very IPOs their banks were underwriting. It was a staggering conflict of interest, and in the mania, no one cared. The factory, the salesman, the megaphone. This is the architecture of the lie. The red pill is this. The dot-com bubble was not about the internet. It was about access. It was about the insiders creating a product, worthless stock, and selling it to outsiders for billions, all while cloaked in the noble language of innovation. They did not just build a new economy, they built a new, more efficient casino, and the house, as always, was designed to win. So, we stand in the wreckage of a $5 trillion lie. What is the lesson that the internet was a fad? No, the internet was, and is, revolutionary. That is what makes the lie so brilliant. The lie takes something true, the internet, artificial intelligence, a new form of energy, and uses it to justify something false and impossible valuation. The dot-com bust is the single greatest case study in financial history, and it provides us with a clear 5-step survival strategy, a system to detect the next new economy lie before it consumes your capital. First, interrogate the metrics. When you hear new, complex jargon, eyeballs, burn rate, total addressable market, be suspicious. These are almost always invented to hide the absence of one simple, old-fashioned metric: profit. Can this business ever make more money than it spends? If the answer is maybe, it is a gamble, not an investment. Second, beware the cult. When skepticism is treated as stupidity, you are in a cult. When analysts who question the narrative are fired or shouted down, you are in a cult. When you feel FOMO, the fear of missing out, remember that emotion is a tool. It is being used by the insiders to create demand for the shares they are about to sell you. Third, follow the insiders, not the hype. Do not listen to what the CEOs say on television. Watch what they do with their own shares. Are they selling? Are the VCs and original investors dumping their stock as soon as the lockup period expires? That is, the short window of time legally requiring insiders to hold their shares after an IPO. If they are cashing out, why are you cashing in? Fourth history is your data set. The salesman will always tell you this time is different. The historian and the intelligent investor knows that is the most expensive sentence in the English language. Human nature does not change. Fear and greed are constants. The patterns of mania, euphoria, and collapse are constants. And finally, fifth price is what you pay. Value is what you get. A revolutionary company can still be a terrible investment. If you pay too high a price, Amazon was a dot-com survivor, a world-changing company. But if you bought its stock at the peak in 1999, you had to wait 10 years, 10 agonizing years, just to get your money back. The dot-com deception is not over. It is the blueprint. The next new economy is already here. The salesmen are already on your screen. The VCs are already packaging the IPOs. The megaphones are already amplifying the hype. They are all counting on one thing that you have forgotten. This channel is the system designed to make you remember.